We are officially on red alert. Stop staring at 5-minute candles. Stop obsessing over RSI. Stop letting the noise hypnotize you. What is happening today, January 6th, 2026, is not a normal market correction, not a healthy pullback, and not some cute little trading setup. This is a war. And today we got the first official confirmation that the western front of that war is starting to collapse. Ladies and gentlemen, Asian guy here. For years we've been the resistance. We've been the ones yelling into the void that the price of silver was a lie, that the vaults were emptier than advertised, and that the banks were running naked shorts. They mocked us. They branded us conspiracy theorists. They told us silver was just a pet rock and that we should shut up, buy tech stocks, and behave. But today, the laughing stopped. Today, the enemy didn't just blink, they folded. We need to talk about Bank of America. Not a tiny regional bank, not a YouTube blogger. One of the biggest, most powerful, and historically most bearish financial institutions on earth. The kind of institution that has consistently leaned on precious metals. The kind that spent a decade telling clients to avoid gold and silver like the plague. The Death Star of this market. And this morning, the Death Star lowered its shields and admitted defeat. Bank of America has officially capitulated. Look at what they put in black and white. For years, they told you gold was expensive at $2,000. Now they're talking about an official target for the average price of gold at $4,538 per ounce. $4,538. That's more than double the old highs. That's not a re-rate. That's a level that screams the fiat currency system is being stripped down to the studs. And they didn't stop there. They argued gold should no longer be treated like a speculative hedge. They said it should make up 20% to 30% of every single portfolio. Think about that. The traditional playbook from big institutions has been 0% to 5% metals. Going from 5% to 30% isn't a tweak. It's panic. It's an unspoken admission that the other 70%, the stocks and the bonds, is staring into mortal danger. And if you think their gold call is wild, listen to what they effectively admitted about silver, because this is the kicker, the smoking gun, the part that makes the squeeze feel inevitable. They looked at historical ratios, they looked at geological reality, and they finally did the math we've been doing for years. They admitted silver is coiled, compressed, ready to detonate. They didn't toss out $80. They didn't toss out $100. They said that based on the 2011 ratio, silver targets $135. But based on the 1980 ratio, they floated the kind of number that makes people choke on their coffee, roughly $3,909 per ounce. Let that sit in your chest for a second. The same kind of institution that helped suppress the price is now letting research circulate that points to numbers that look like science fiction. So why are they doing this? Why now? Why, after years of trashing metals, would they flip the switch? Not because they suddenly love you, not because they want you to get rich. They're doing it because they're trapped. They're staring at the same data we are, and they see a catastrophe coming down the pipe that can't be hidden anymore. They know the paper game, the ability to print infinite contracts and lean on price, only works as long as physical metal still moves in the background to satisfy delivery when the system demands it. But the physical metal is disappearing. In the same report, they quietly nodded to the supply-side horror show. Global mine production is weakening, and they expect production to be down 2% this year. And it's not just that mines are producing less, it's that the cost to pull metal out of the ground is exploding. Energy costs are up, labor costs are up, equipment costs are up. All-in sustaining costs have jumped so hard that at $70, a lot of mines were barely surviving. But at $300, the economics finally work. Bank of America understands that prices must rise to incentivize production, or the industrial economy ends up with literally zero silver available when it needs it most. So they're pre-positioning. They want to be able to say, "We warned you," when the chart turns into a vertical wall. They want to stand on the right side of history when the squeeze hits, even though they spent the last decade on the wrong side of the trade. And that capitulation, this moment where the biggest bear morphs into a bull, is the signal we've been waiting for. Every major bull market has a moment where smart money stops fighting the trend and starts chasing it. That moment is today. Because if the biggest seller turns into a buyer, who's left to sell? The sellers have left the building. There's a vacuum above us. And while Bank of America is looking at charts and mining reports, they're also looking east, at the real reason the physical market is drying up. They're looking at the dragon that just woke up and decided to consume every ounce of metal it can touch. Because while Western banks write reports, the Chinese state takes action. We need to talk about the liquidity bomb that just detonated in Beijing. You can't understand Bank of America's panic until you understand the tsunami coming out of the People's Bank of China. While Western media gets hypnotized by quarter-point rate cuts and unemployment decimals, Beijing has initiated what I'm calling the single largest monetary event in human history. Not a stimulus package, not an infrastructure bill, a liquidity injection so massive it bends the global economy's gravity. Reports claim China expanded its M2 money supply by 48 trillion. Context: that's described as roughly double the entire M2 money supply of the United States. Remember what happened when the US printed 5 or 6 trillion during the pandemic? Prices surged, housing ripped, the cost of living jumped. Now imagine a monetary bomb nearly 10 times that size detonating across the Asian market. But here's the critical difference. This is why this time is different. When the US prints, the money floods into the stock market, into Apple, into Nvidia, into derivatives, into the machinery that props up banks. The Chinese aren't doing that. They're not printing 48 trillion to rescue developers or to juice the Shanghai index. They're printing with one strategic purpose: convert paper into hard assets before the system snaps. It's the largest wealth transfer in history, executed in real time. They print fresh yuan and deploy it like weaponized capital into global commodities: oil, copper, pork, but most aggressively, gold and silver. It's as if they're saying, "We will give you paper we created out of thin air, and you will hand us physical metal that took billions of years to form and millions of dollars to mine." And the West, stunningly, takes the deal. The West ships gold and silver eastward in exchange for fiat being debased at a pace that looks like 48 trillion a cycle. This is the black hole effect we warned about. China turning into a gravity well for precious metals. That torrent of liquidity creates an unlimited bid in the East. If silver hits $85, they buy it. If it hits $90, they buy it. They don't care about the price in yuan because they can print infinite yuan. They care about ounces. They know whoever ends up holding the most ounces when the music stops gets to write the rules of the next monetary order. So they sweep shelves, they drain London vaults, they pull supply through Swiss refineries, they drain COMEX, yes, COMEX, because physical is what matters, and that's why premiums are exploding. Normally, when a government prints like this, the currency collapses, but the yuan isn't collapsing against the dollar yet. Why? Because they're backing it with what they're buying. They're turning the yuan into a resource-backed currency in real time while the dollar stays backed by nothing but debt and F-35 fighter jets. That 48 trillion wall of money is the force that breaks the back of short sellers. Bank of America sees the M2 figure, runs the simulations, and realizes no amount of paper shorting in New York can stop a Beijing-scale buying spree. If JP Morgan dumps 1 billion ounces of paper to smack the price, China can simply print enough yuan to buy the physical metal those contracts pretend to represent. The shorts are bringing a knife to a nuclear gunfight. This is why paper price is becoming irrelevant. The spot price on your screen is formed during Western trading hours, but physical flow is decided by Eastern buying power, and right now the East has 48 trillion reasons to win this tug of war. Every dip gets bought, and that buying builds a floor that rises day after day. They're not trading for profit in dollars, they're trading for survival. They see the US dollar system approaching an ending. They see the debt spiral as mathematical certainty, so they're getting out of the burning building first, and they're taking the valuables with them. That sets up a collision of epic proportions, the unstoppable force of Chinese demand, fueled by the biggest money printing operation in history, slamming into the supposedly immovable object of Western bank manipulation. But the immovable object has a fatal flaw. It's hollow. It's built on leverage, lies, and empty vaults. We need to talk about the specific position the Western banks are stuck in, because while China is long everything, the banks are short everything. And the size of the short isn't just dangerous, it's mathematically impossible to cover. Let's look at the death trap. Let's look at the 4.4 billion ounces that are poised to blow up the world. This is the glass jaw of the Western banking cartel, the number that keeps risk managers at Citi and JP Morgan drenched in sweat at 3 a.m. That number is 4.4 billion. Based on analysis of the bank participation report and derivative books of major swap dealers, the combined net short position in silver is estimated around 4.4 billion ounces. And big numbers get abstract, so let's anchor it in reality. The entire planet, Mexico, Peru, Poland, Russia, produces about 800 million ounces of silver per year. That's the cap. You can't print ore, you can't accelerate geology. 800 million. So do the division. 4.4 billion divided by 800 million is roughly 5.5. The banks have sold, on paper, 5.5 times humanity's entire annual production. They're short about 550% of global supply. In equities, if a fund is short 20% of a float, we call it crowded. If it's short 100% like GameStop, we call it the mother of all squeezes. But in silver, we're talking 550%. That level of leverage has no clean parallel in modern financial history. And here's the trap. They sold that silver years ago. They sold at $20, at $25, promising to deliver metal they didn't have, assuming they could always smash price and buy it back cheaper. But they didn't count on the Chinese liquidity pump. They didn't count on the solar chokehold. And now, with price ripping through $80, they're underwater in an astronomical way. Every single $1 move higher costs about $4.4 billion in mark-to-market losses. If silver goes anywhere near the Bank of America target numbers being discussed, the losses aren't merely painful, they're terminal, extinction level. But money still isn't the biggest problem. The biggest problem is physical reality. A short is a promise to deliver. When you're short, you owe metal. In the past, banks could settle in cash. We don't have the silver, but here's a check. Speculators took the check. But today, the counterparty isn't a speculator. The counterparty is China. The counterparty is the solar industry. The counterparty is the Pentagon. They don't want cash. You can't build a solar panel with a check. You can't build a missile with a wire transfer. They demand the bar. And when they stand for delivery on 4.4 billion ounces, while the vault only has 300 million ounces inside, what happens? The system breaks. It hits a brick wall at 1,000 miles per hour. This is the margin call from hell. It forces the banks into the open market as buyers. Imagine the panic. The same entities that have suppressed price for 2 decades suddenly have to switch sides and scramble to buy back 4.4 billion ounces to cover naked shorts. But who sells it to them? You? China? No, we hold. China buys. So the banks end up bidding into a vacuum. $85, no sellers. $90, no sellers. $100, still no sellers. That's how you get a vertical move, gaps on the chart where trades never even printed. That's how you get to $3,909, not in 10 years, but in 10 days. It's mathematical. Fixed supply of 800 million ounces. A demand shock supercharged by 48 trillion. A short covering panic of 4.4 billion ounces. There isn't enough metal in the Earth's crust to bail them out. They sold the wind. Now, they reap the whirlwind. And that brings us to the most dangerous deception happening right now, because the banks know they're trapped, and they know the math better than most people do. So what's the last move they have left? They have to trick you into giving them your silver. They have to paint a high number on your screen that tempts you to sell, even though it's a massive discount to reality. They want you to see $80 and think, I'm rich, time to cash out. Do not fall for it. We need to talk about the $80 trap, the difference between the number on your monitor and the real value of the metal in your hand. Because right now, the market has split in two, paper versus physical. And if you don't understand the difference between the screen and the street, you're going to get slaughtered by the oldest trick in the book. You're looking at a trading app. You see silver ripping green candles, $80 an ounce. I see the comments and the victory laps, people saying, we made it, stop celebrating. Because what you're staring at is not the value of silver, it's the price of a paper promise on the COMEX futures exchange. And I'm telling you with absolute certainty, $80 for a physical ounce of silver is trash paper. It's a lie, it's manipulation. It's a trap designed to steal your metal before the real move even starts. Here's the reality check. Don't trust the chart, trust the market. Pick up the phone, call your local bullion dealer, call the big online retailers. Ask them to sell you a 1-ounce American Silver Eagle for $80. Ask for a 10-ounce bar at $80 per ounce. You know what they'll do? They'll laugh. They'll tell you inventory doesn't exist at that price. They'll tell you the real number, the number required to actually hold the metal, is $90, $95, and in some places for premium coins already over $100. That's the decoupling, the snap where paper and physical separate. The banks use high-frequency algorithms to pin the paper price around $80 because that's where they can manage damage. They want you to think $80 is a gift, a perfect selling point, so you dump your physical stack back into the system and they scoop it up to plug their 4.4 billion ounce hole. They're fishing for liquidity. They're dangling a worm. And if you sell physical at $80, you're selling a winning lottery ticket for the price of a ham sandwich. You're handing away the one asset that shields you from the 48 trillion inflation tsunami. Look at premiums. In a healthy market, premiums are small, $2, $3 over spot. But now we're seeing $10, $15, even $20 over spot. That tells you spot is fake. Spot is broken. If spot were real, arbitrage would close the gap. Traders would buy paper, take delivery, and sell metal to dealers. The fact that the gap stays wide proves COMEX isn't delivering metal the way people assume. The paper contract is defective, like a check that bounces. The paper says $80, but the bank says insufficient funds. That's why Bank of America talking about extreme numbers matters, because they know the paper theater eventually ends. They know the paper market will shut down, cash settle, or get forced into a new reality where only physical sets the price. And when that happens, price doesn't politely drift from $80 to $100. It re-rates overnight. It gaps to $150 in a single session. That's what happened in nickel. That's what happened in palladium. When physical shortage goes acute, the chart goes vertical. So hear my warning. Do not let green candles fool you into thinking the squeeze is over. The squeeze hasn't even started. What you're seeing is the pregame show, the banks trying one last time to shake out weak hands. They're hoping you're desperate or bored enough to sell at $80, but you need the mindset of a central bank. Does China sell when price rises? No, they buy more. Does the Pentagon sell when price rises? No, they build smelters and hoard. So why would you sell? You're holding the collateral of the next world order. You're holding the battery of the green energy revolution. You're holding the only form of money with no counterparty risk. And right now, the most powerful institutions on earth, from the People's Bank of China to Bank of America, are in a war to separate you from that metal. The $80 trap is their weapon. Don't walk into it. Don't trade real wealth for dying promises. Because if you sell now, you won't get back in. You'll look back at January 6th, 2026, and realize it was the last day silver traded under 3 digits. You'll realize $80 was the sale of the century. So we have capitulation, we have shortage, we have a fake price. What's the final verdict? What's actionable for an investor standing in the middle of this battlefield? Even if the banks wanted to cover 4.4 billion ounces, even if they printed infinite money, they've slammed into a problem no financial engineering can fix: the supply cliff. In that same discussion where Bank of America raised targets, they admitted the most terrifying statistic of all. Global silver mine production is expected to fall by 2% this year. 2% sounds small, but in commodities, a 2% supply contraction during a 20% demand explosion isn't a deficit. It's a famine. The shelves empty every single day. And here's the secret miners know, but Wall Street is only now learning. Price does not instantly create supply. This is the inelasticity trap. Bankers think if silver hits $100, miners turn a dial and crank out more, like a factory adds an extra iPhone shift. A mine isn't a factory. You can't turn up a mine on Monday and flood the market on Friday. If silver hits $100 tomorrow, do you know how much extra silver comes out next week? 0. It takes 10 years to find, permit, build, and operationalize a new silver mine. 10 years. So even if we started today, which we aren't, the metal wouldn't arrive until 2036. For the next decade, we're stuck with the supply we have, and that supply is weakening. Why? Because of the easy silver fallacy. For 100 years, we mined the high-grade stuff near the surface, the low-hanging fruit. Now we dig deeper, process more rock, burn more energy, just to get the same ounce. Grade degradation is real. In 2005, you might pull 15 ounces of silver per ton of rock. Today, you're lucky to get 4. That means mining roughly 3 times the rock for the same ounce. More diesel, more electricity, more labor, more inflation pressure. So as energy prices rise, mining costs explode. Bank of America knows that at $70, many mines were barely profitable. They know the price has to go toward $300 for the industry to justify sustaining production. And there's another nightmare layer. Most silver, nearly 70%, isn't mined as primary silver. It's a byproduct of lead, zinc, and copper. That means silver supply is hostage to the base metal cycle. If we hit a global recession and demand for lead and zinc drops, those mines shut. And when they shut, silver supply evaporates. So you can end up in the most absurd scenario imaginable. Demand skyrockets from solar panels and investment while supply crashes because base metal mines close. A perfect storm of structural scarcity that money can't fix. This is why Bank of America surrendered. They looked at charts, vaults, and mines and realized there's no cavalry, no flood of new supply coming over the hill to rescue shorts. The hole is real, it's deep, and it's widening. They realize they're effectively short billions of ounces of a metal that's starting to behave rarer than gold in the places that matter. So they did the only rational thing left. They switched sides. They stopped fighting geology and decided to ride the rocket. And that brings us to the moment of truth for you, the individual investor. You've now seen the full battlefield: bank capitulation, the China liquidity bomb, the short squeeze math, the fake price trap, and the geological cliff. Technical, fundamental, and geopolitical signals are all pointing the same direction. Up, and not up like a stock, up like a revaluation of reality. The time for endless analysis is over. The time for hesitation is over. We're in the execution phase. The window isn't closing by the day, it's closing by the hour. As we speak, Asian markets are opening again. Premiums tick higher. Inventory disappears. So here's the final message, the go order. For the army of silver stackers watching this: do not sell. I don't care if the screen says $85. I don't care if it says $90. Do not trade sovereign wealth for dying promises. Do not let them trick you into bailing them out. They are drowning, and they want your silver as a life vest. Don't hand it to them. Let them drown in their own liquidity. Instead, if you can still find metal, if you can find a dealer who hasn't fully awakened to what's happening yet, or a neighbor who's asleep at the wheel, buy it. Buy the premium, buy the scrap, buy the junk silver. Clear the shelves because the window is closing. We are entering a period where silver becomes unobtainium. Soon you won't ask, what's the price? You'll ask, is there any left? And the answer will be no. Bank of America gave you the target, $4,538 gold and the explosive silver logic. China gave you the catalyst, 48 trillion. Geology gave you the guarantee, production collapse. The universe is screaming at you to hold the line. We won the argument. Now we win the war. The Western Front is collapsing. The enemy capitulated. The road to triple digits is wide open. Don't waver. Don't blink. This is the moment we prepared for. This is the wealth transfer. The alert is red. The target is locked. Go, go, go.